Oh, that means I have to retweet. Alrighty, let's retweet and let's get started. Let's first find this retweeting. Too many screens open. I have nothing to retweet. There's nothing already posted on Wall Street Beats. All right, I got it. I got it. Sounds great. It is February 17th. I think it's the start of Chinese New Year.
Oh, is it?
You're the horse.
Yes, thus the red shirt. Supposedly, for good fortune, you're not supposed to wash your hair or clean today. Bob and I probably can get away with the first, but I don't know about all the rest of that. So I used to work for a Chinese bank before it was owned by the Chinese, but it was CLSA. And every year they would put out for the Lunar New Year what stocks are going to do well, what sectors, and they would have a feng shui master write about this. It was a very in-demand report from around the world. Like, it was a very in-demand institutional report. I don't think anyone was really following it, but it is like reading fortune cookies or horoscopes that you might not believe it, but you still want to read it. Why not? Let's see. I don't know what the Chinese New Year says about for oil and gas stocks or for banks, but we're going to find out from Bob Morris and Charlie Peabody. So, Bob, maybe we can first talk about what does the Chinese New Year have for what does the Lunar New Year have for bank and for gas and oil stocks. What's on your mind today?
So, as we've talked about for the last several weeks, the headlines are driving oil prices, and ahead of continued talks between the U.S. and Iran, oil prices are giving up a little bit. They're flattish here this morning. They were up earlier this morning on concerns about Iran closing parts of the Strait of Hormuz to do some military drills, which was really not a big deal. But the fact that the talks are ongoing here, and everybody knows that the Trump administration drives a very hard bargain, that you don't want to mess with Trump in that regard, that he's already, they've already bombed their nuclear facilities. We know what he did in Venezuela. I think oil prices are giving a little bit back or pausing here just in the anticipation that perhaps there is some breakthrough, or at least there's not a outbreak of any sort of military action. And even if there is, that could be the break to sort of lead to some sort of agreement or some sort of caving, so to speak, by Iran in these negotiations and giving in and moving in that direction. I think right now, the point I want to make too is that I think there's probably around a $3 to $5 per barrel geopolitical premium in the price of oil today. So up here around $63 a barrel. As we've talked about, it should be around 60, apart from these geopolitical factors that continue to provide some crosswinds between not only what's going on with Iran, but what's going on with Venezuela, what's going on with Russia and Ukraine, what's going on with demand in China, economic growth and demand and so forth. In the meantime, if you look at the market, it appears that there's some profit taking across the energy sector here, with oil prices having moved up sharply, and some of the energy stocks giving some back today, and in particular with natural gas, as we've talked about, moving closer to the shoulder period where demand wanes and we're looking at some warmer weather out in the future forecast. The natural gas is down here approaching $3 again. As far as the stocks here, I'm tempted on some names like C&Q, since I've got such a large position, writing some out-of-the-money calls. And so I did a little bit this morning, looking out to the June 45s, which $45 a share would be an all-time high for this stock. You can get around $1.30, $1.40 in writing $45 June covered calls, which I think is good for this stock. On Friday, this stock came within less than 50 cents of an all-time high. And they have yet to report earnings. I do anticipate that they'll once again increase their dividend when they do report earnings. And so just risk management, I'm tempted to just, starting out with a little bit, but just take some premium profit in here and writing $45 out of the money June calls that you can get, basically adding 3.5% to the price of the stock today and writing those covered calls. So that's basically all I'm looking to do here this morning, is I'm watching things. As we mentioned here a couple of weeks ago, we already wrote 105 covered calls and $55 covered calls respectively on EXE, or Expand Energy, and EQT. looking out to May and June. So those are playing well now, and very happy with those positions. I did it on half those positions, just again anticipating this pullback in natural gas prices hitting into the shoulder period in the spring. That's sort of what's on our mind. We'll watch. The headlines are going to be key here. Right now, near term, the biggest factor or influence on oil prices will be any news out of these negotiations between the U.S. and Iran, which, again, I think the market's sort of anticipating that they'll probably ultimately go in the direction of the Trump's administration's favor, just given we know they do carry a big stick.
So what's the best outcome? Like what should we expect and what's the time frame?
Time frame's difficult. I think from the U.S.'s perspective, the time frame is very short. They have some demands. They want to see them come to the table to indicate that they're willing to cut back or dilute their nuclear program or dilute their uranium enrichment program in return for lifting sanctions. And I think discussions go in that direction. If that actually does occur, could that happen in the next several weeks? Yeah, I think it could happen in the next several weeks. I doubt very much the Trump administration is going to sit on their hands very long if Iran is just stonewalling him and refuses to come to the table and discuss in any manner the demands they have. And then, that does put on the table some sort of military action or intervention, starting with maybe further bombing of their nuclear sites facilities that they begin to rebuild. So I think as far as some break in the talks one way or the other, I think you're talking a matter of weeks. So it adds a lot of volatility to these stocks. And again, it's interesting that a lot of these energy stocks are clearly some profit taking here after this sharp run up year to date. I think year to date, energy's been the top performing sector.
Bob, how important are these non-OPEC oil producing countries at the margin? So the reason I ask is I think there was some talk about Kazakhstan not being able to export oil because they export through the Russian port facilities that had been bombed. We know Venezuela is a long-term project to come on, Guyana, Brazil. I'm hearing that maybe the supply from these countries is not going to be what was anticipated. I don't know if that's important or not.
On the margin, it's important. I mean, there's a lot of new oil production coming on offshore Guyana. And as far as Venezuela, it's small near term. There have been shipments of condensate or diluent for that heavy oil in Venezuela to be able to more easily ship it to the Gulf Coast refineries in the U.S. who are more capable or built for that heavier crude oil. The U.S. has continued to clamp down on Russian exports, and a couple of weeks ago, getting India to agree to not buy Russian oil, although China continues to buy Russian oil. So on the margin, is supply increasing? Yeah. Is it going to be less than what people anticipate? I don't know if it's going to be less. I mean, coming into the year 6 months ago, the big concern was that there would be an oversupply in 2026. Those oversupply projections have narrowed largely on just continued demand growth from the strong economy in the U.S. and in China. So when you talk about the other OPEC producers, remember also that, 3 times now OPEC's upped their production or output goal, just putting some of the reduced barrels back into the market. Some of the OPEC members just aren't capable of producing more, and those that have put more oil in the market have done so, but it's not a situation where there are projections for more oil that's not occurring at this point, if that makes sense. I think, is the market overestimating the supply growth? I don't think so. From outside of what's going on with Russia and Iran and everything on these sanctions, no. The thing is, if there is an agreement with Iran and the U.S. does lift sanctions, that's negative for oil prices. If there is a peace agreement between Russia and Ukraine and the U.S. lifts sanctions on Russia, that's negative for oil prices. That's more oil more freely in the market. So those may be bigger factors longer term, I don't mean longer term, but medium term, than other things that occur here. And that's why it's so critical on this geopolitical premium in here is what has oil prices where it is today. And in near term, it's just what happens with Iran. But again, like I said last week, if peace breaks out, there's more oil in the market.
So we get more oil in the market, and we'll say, again, I know each one of these is a different lever. If Russia all of a sudden becomes a good neighbor, that's very different than if Kazakhstan gets to trade their oil freely. But if we saw oil down below $60, what names are most sensitive to that? Or is it kind of a one-time shock and it's not really something to worry about?
No, I mean, if oil pulls back $45 a barrel here, stocks are not going up. It's who's the most sensitive. I think certainly C&Q, Occidental Petroleum, Apache. Those are probably the more oil-levered names among the independents. I
And
mean,
from based on what
the
based on what you
majors are, but
said,
the majors are a little bit insulated by having the downstream operations because then their refining operations are refining cheaper oil. So there's a little bit of a cushion there. The higher beta names are the pure oil and gas producers, the E&P names.
based on what you said, it sounds like Iranian deal or stability is moderate. Russia deal, obviously, much more significant.
Yes. And, there's probably, if tomorrow it came out that, oh, well, we've reached a deal with Iran, they're going to stop nuclear enrichment or dilute it, and the U.S. is going to lift all sanctions against them, oil probably pulls back $3. We're back to 60 pretty quick, or maybe 59, 60.
Have you looked at any of the like poly markets or
I knew you were going to
betting?
say that. I have not. That's the bet you need to look at is look at Polymarket and see where the bets are here. I should have looked at that this morning. I didn't. I've got Polymarket on one of my tabs here, but I didn't look at that.
That's
Hey,
getting
David or Bob, question for either of you. We got the 10-year approaching 4% now, and SOFR is starting to build in, another rate cut. Do you think those rate bets that are starting to, forecast lower yields are a function of what oil is going to do, or is there something else moving rates? Do either of you have an opinion on that?
I don't think oil's playing into that. As far as the rate cuts, I think it's more what it does for the economy and demand for crude oil.
Yeah, I mean, I would agree that this is more of we're getting closer to Trump's appointment. And while I'm sure there wasn't an acid test question in the interview process of, I need you to guarantee that you're going to lower rates, I think we've all been in interviews where the obvious questions being asked in a non-obvious way. So I think it's just getting it closer to the reality that things economically aren't. I mean, the data so far hasn't been bad, but it hasn't been so good that a rate cut would be taken off the table. Where you'd say, okay, inflation's out of control, so we really can't lower rates again. I think it's this last read was okay, rate cuts on the table, and every day we get closer to that happening.
Well,
What do you
the
think?
thing is, if you look at people are now looking ahead to the midterms later this year, and the biggest issue is affordability, which inflation plays into that directly. So the two biggest levers that the Trump administration would love to pull to address affordability issues is lower rates and lower energy prices. If Trump had his dream scenario, it would be peace between Russia and Ukraine, peace with Iran, and an acceleration in reviving the oil industry in Venezuela to drive oil prices down. The thing that Trump would love, what would help him the most in addressing what is probably the biggest issue heading into midterms, is rate cut and bringing oil down to $50 a barrel. That would be his dream scenario over the next 6 months.
Yeah, I'm kind of leaning more with Bob than you, David. I think if the market is expecting rate cuts from a Trump Fed appointee, the long end would be selling off, and that's not happening. So in last week, the bank stocks broke hard for the first time in a while, and it was during this period of concern about software and AI disrupting various industries. And I'm wondering if the marketplace is smelling a little deflation. In other words, if I'm a bank and I've been doing a lot of asset-based lending to software companies or to wealth management operations or to commercial real estate services operations, et cetera, and all of a sudden those asset values are being reassessed, my loan to value cushion is not as great. So this is what I wrote about this weekend are we emerging with an asset-based lending problem where asset values are going to be reassessed? And this is at a time when margin and leverage is at record highs. And so the unwinding of that, leverage and margin debt could further deflate asset values in a very rapid way that doesn't allow the banks time to adjust. So I think you got to watch the bank stocks here very carefully. They got a little bounce this morning, but I think they're going a lot lower into the spring. And I think they're smelling some asset deflation here.
All right. Well, I think both things can be true.
Yeah.
But I do think that you're right, Bob, that if he had his way, oil would be a lot lower, even though gas prices are pretty low. So he has in Georgia today talking about affordability, and they've been putting out a lot of press about gas prices are down. If you look at peak Biden versus peak here versus where we are now at the same date, we're a dollar lower. So all of those, they're trying to get the messaging out. You can tell people that eggs are cheaper than they were a couple of years ago. But no matter how much you earn, you are always in the feeling of things are more expensive because they are. And because eggs might be or gas might be cheaper, that doesn't mean that buying a car is any cheaper. So it's interesting. I think that had the big, beautiful bill started 6 months earlier, that might have been helping things too. So at least on the data.
I mean,
David, can I, sorry, are you finished?
Yeah, I wanted to move to you, Charlie, to see what you have to talk about today. I know you've been on a bit, but what's and you just mentioned my dear bank stocks have been getting killed. My former employers that I've kept their stock. I was so happy the last few years I kept it. The last week I haven't been happy, but I only remember the last week. I don't remember the last couple of years.
Well, the bank stocks have a little bit of a bid this morning. I don't think it'll last. And I'm not really sure why they're getting a bid today, but it could be related to a speech that Michelle Bowman, Fed governor and head of bank supervision at the Fed, gave yesterday. And yesterday she argued that there needs to be capital relief around the mortgage banking industry for the commercial banking industry. In other words, reduce the capital requirements related to mortgage origination and mortgage servicing. And I want to put this in a little perspective. So the big bull case, if you're talking long term to buy the banks, is that under the Trump administration, there's going to be deregulation and there's going to be relief on capital and liquidity requirements. And that relief will start to shift the arbitrage that was in favor of the non-banks back to the banking system. And so all the loans that went to private equity, private credit are now going to come back to the banking system. All the mortgage banking that went to Rocket Mortgage or UWMC Holdings or, is going to come back to the banking system as they change the dynamics of capital and liquidity. And so that may be why, you got a little bit of a bid here in the bank stocks today is that deregulation theme, got another, tailwind yesterday with Bowman's speech. Jenny, I don't know if you can put up the table that I produced this morning, but this is a table of mortgage banking revenues on the left-hand column. And then I give you fee income because mortgage banking revenues are a subsegment of fee income. And then I give you total revenues. And then I express that mortgage banking revenues as a percentage of fee income and then as a percentage of total revenues. And you can see it's fairly small. It's less than 10% of total revenues for all these big banks. And so it's not going to move the needle if they improve the dynamics for mortgage banking through capital relief. It's not going to move the needle for earnings in the short run. But I will point out, and as Michelle Bowman did, if you go back 15 years ago, banks were 60% of all mortgage originations. Now they're 35%. So they've lost huge market share to the non-banks like Rocket Mortgage. The idea is that the Fed changes to capital requirements and liquidity requirements will push that pendulum back the other way. And if you look at like JP Morgan's revenues, of $4.7 billion of mortgage banking revenues, if you go back to 2012, that was closer to 13 billion. So there's substantial upside if they can take back mortgage share. But it's not going to happen in the short run. Anyway, it may be one of the reasons, this general theme of deregulation and how the banking system is going to win back share from the non-banks. But if the banks are being bid up on this today, then Rocket Mortgage should be being bid down. I haven't looked at the stock RKT or UWMC. There should be a tit for tat here. Anyway.
Well, Rocket Company's RKT is down 3% today.
Okay. So that may be what's going on today. As I said, this speech was very visible yesterday. It got, highlighted in the FT and Bloomberg and the Journal. So maybe that's what's going on here. I honestly don't think I'm very bearish here, David, and probably the only thing that I have left in my portfolio is energy stocks, and everything else I'm short. So
Well, okay. Well, I think you should have had some pharma in there, because if we look at I
I did.
posted
I had Danaher, and it's not helping me today. What happened there?
you can't own one. I mean, that's as you know, owning one great company is the definition of being disappointed. It's like it's only great, when you put it in or when you sell it. So let's see. Look, pharma's done really well so far, week to date, month to date,
It
meaning
has.
last week. It's doing what you would think it would do, which is be defensive in a time when a lot of people are worried about different things. Both of the things you mentioned are big slices of the stock market and the economy. But you have pharma this last week up 3.5%. In the last, like, let's say month to date. I don't know why. I sent around for the subscriber chat this chart that's very helpful. They don't do year to date, they do week to date, month to date, and 3 months. For some reason, they don't put year to date in there. Simple. I'm going to tell this friend of mine that does this to fix that. But if you look at just pharma, up 3.5% last week. In the 3 months, it's up 15.6%. Energy is up 18.9, so pretty good. If you look at financials, 1.5% for the last week, only 2.8% for the 3 months. So it's kind of treading water during that time, matching the S&P 500. Pharma's
What
doing what?
benchmark are you using for financials? Because I have them down 6%.
That's a good question. Again, it's from a friend of mine at Deutsche Bank who's the healthcare specialist. So who knows? Maybe he's using the absolute wrong ETF or something because he's a pharma guy. I'll definitely ask him once we get off the call
Yeah.
today. But what we're looking at though is really biotech 15% in the last 3 months. Everything, all of healthcare doing what healthcare should do and be defensive. And we mentioned it a couple months ago, whenever the Trump administration did their deal with pharma, that okay, overhang lifted. Now we can go back to normal. They've started reporting earnings. The earnings look great. Pharma early in the year tends to hold back and then do even better later in the year. They're smarter than the average companies, but they reported mostly really good numbers. So you didn't really have blow-ups in the large pharma group, knock on wood, yet. And they shouldn't, right? Because you have 50 different products, all that you can set the price on. Not so bad. Obviously, competition for any individual product does matter for these companies, but my point is that this is a pretty protected industry. And I think that we're in a pretty good spot. Let's see on a day like today where things are not doing well.
While you're looking at that, David, I just say, I did follow you into healthcare back in, I don't know, it was November, December, and had a really nice run. So kudos to you for your calls. And may have bought a few different things than you did. I mean, Moderna was my big winner. I bought that between 23.28, 23.28 all day long.
Yeah, that was a really good call. I remember when you said that, and I didn't disagree with it, but after we hung up, I said like, yeah, that's smart, especially we're going into a higher than average flu season. Like it was tracking higher than average, and these stocks do trade on because you have portfolio managers who don't fully understand, or maybe they do. They just say, well, I don't care about the buying is because flu vaccines get shipped way before the flu season. But if flu starts to look worse than expected, they go, oh, that's in the press. I'm going to buy some. Whether they know that or whether they just do it kind of reflexively, I'm sure there's some in both camps. But I remember hanging up from that show and going, that's a really good idea. I should do that. And then I didn't do it. And obviously that
Well,
bothers me.
you had a lot of good ideas, David.
Well, yeah.
Yeah, no, you looking at here, Pfizer, Merck, J&J, Amgen, all up nicely year to date. Those have all been great calls. I mean, those are the four names I bought, largely on
And
your
last week,
recommendation, but those have done
I talked about
extraordinarily
how
well.
excited, last week I talked about how excited the banks were about, the M&A opportunities, not in banking, but as investment bankers to other industries. And one of the areas that they highlight three areas where they thought it was going to be huge. One was the whole healthcare biotech sector, particularly biotech.
Yeah, because if you've had 5 years of underperformance, then all of a sudden things start to perk up, and those products that they were working on are a little bit further along. That's what you've seen. The companies that have really gone to town are the companies that are, and most of the large pharma is really well capitalized, but the companies where their stocks have done incredibly well, like Lilly. I don't even know how many deals Lilly has done this year. I don't even know if they know how many deals they've done in the last year. It's really, I mean, I think they put a bid on my. I mean, they're really. But when your stock goes from 500 to 1,000 in a couple years, you know, your business development team probably has grown by 3x. But I think that this is going to continue. Again, I think the things like the administration taking a tougher view on insurance companies is more likely than going back to pharma. So I think we're going to call it there for, unless you have any other comments.
David, those names you mentioned, or I mentioned too, all pay nice dividends. So, if there's a rate cut and dividend seekers, those are all good names that provide nice yields in a rate cut environment too, if they, apart from everything else.
Yeah, I heard someone today talk about General Mills when I was driving into the office. Someone on one of the radio or CNBC was saying General Mills is down a lot today. And maybe it's GLP-1s, maybe it's, they said changing consumer behavior, maybe it's whatever. And by the way, cereal's fantastic. Fiber is important. I don't own any General Mills, but they mentioned about the dividend, and they said, and it's solid because it's covered by cash flow. Which now I have to go back and look into the balance sheet and see, because obviously dividends are covered by cash flow, but that doesn't mean it's covered forever for cash flow. When you think of pharma dividends, like it's so much more stable in my opinion. I can't recall, and I don't want to jinx this, but I really can't recall the last time a large pharma company put a dividend either on hold or said like, hey, this year we're not increasing it. I mean, Pfizer always has that risk, and people mention that. But I'll tell you, if you own a group of these, I think that it's from a dividend standpoint, it's pretty secure. Unless we have some sort of wholesale change of our healthcare system, I don't see how they don't keep printing money. Well, with that, everybody, it's the end of our show. It's sad to say goodbye. Enjoy the Lunar New Year celebrations, whether you're having them today or this weekend. For everyone at Wall Street Beats, Charlie Peabody, Bob Morris, I'm David Maris. Have a great Tuesday and great rest of the week.
Yes.